Did you know the single most traded asset in all of crypto isn't Bitcoin or Ethereum? Nope, it's Tether. Every day, billions of dollars move through it. On paper, it's simple. One Tether equals $1. Safe, stable, no surprises. Sounds boring, right? Well, here's the twist. Nobody outside the company really knows if every Tether is actually backed by $1. And yet, this one token has quietly become the backbone of the entire crypto market. It moves billions, buys up US government debt, and, depending on who you ask, might be the plumbing that keeps the whole system flowing, or one of the greatest financial time bombs ever built. So the question is Tether just a harmless tool, or is it something more dangerous, maybe even one of the greatest economic heists of our time? Well, stick with me, because in this video, we're going to break down exactly how Tether works, why it matters, and what could happen if the trust holding it all together starts to crack. And trust me, you're going to want to hear the end of this one. Let's start with, what is Tether and why it matters? Tether, officially known as USDT, is a kind of stablecoin. That means it's a crypto token meant to maintain a fixed value in this case. The idea is, for every USDT in circulation, there should be a real dollar or equivalent asset backing it somewhere. Over time, USDT became one of the busiest currencies in the crypto world. In fact, it holds a massive share of stablecoin volume. Think of it as the grease that keeps all the trading wheels turning. Lending, transferring, buying, selling. If you pull Tether out, half of crypto freezes, which is why doubts about it can ripple across the whole system. Imagine if tomorrow people stopped trusting it. You'd get a digital bank run, everybody trying to cash out at once. And that's where the danger lies. If you're thinking this all sounds too calm, don't worry. Tether's story has all the ingredients of a financial thriller: secrecy, lawsuits, and a healthy dose of just trust us. It launched back in 2014 and quickly became tied to Bitfinex, one of the biggest crypto exchanges. In fact, the two have overlapping owners and management, which has fueled years of questions about where one ends and the other begins. From day one, Tether's claim was simple: every single USDT is backed by real reserves. Dollars, US Treasuries, maybe some other assets. But for years, critics pushed back, pointing out that Tether never produced a full independent audit. What we got instead were limited attestations, snapshots of reserves at a single point in time rather than a complete picture. In fact, there was a showdown in New York. The state's attorney general accused Bitfinex and Tether of quietly covering an $850 million hole by moving money out of Tether's reserves, essentially borrowing from the very safety net that was supposed to guarantee stability. Tether denied wrongdoing, settled without admitting guilt, and since then has doubled down on transparency claims. These days, it releases quarterly reports and insists most of its assets are US Treasuries and other safe instruments. Still, for many observers, it isn't enough. When you're talking about something that props up entire markets, trust doesn't come from promises. It comes from proof. And that's the sticking point. Tether asks the world to take its word, while holding an influence so large it's almost invisible. Now, if Tether is legitimate, you'd expect it to just coexist quietly as a tool. But it hasn't been quiet. Its influence is enormous, perhaps too enormous for something meant to be just a stable token. First, Tether is a massive buyer of US Treasury bills. By the first quarter of 2025, USDT-related entities held roughly $98.5 billion in US Treasuries, or about 1.6% of outstanding Treasury bills. That level of influence gives Tether sway over a major slice of government-issued debt. That means Tether isn't just a pass-through, it's a player in sovereign finance. Researchers have identified that its share in Treasuries is linked to lower short-term yields, effectively subsidizing US borrowing costs. Second, multiple academic studies have looked at the timing of Tether minting, that is, creating new USDT and corresponding movements in Bitcoin or other crypto prices. Some suggest that new USDT issuance tends to happen during market downturns, injecting fresh liquidity to push prices up. Critics say that looks like market manipulation. Third, because Tether is so deeply embedded in crypto markets, any shock to confidence in it can cascade rapidly. If people start questioning whether it's fully backed or whether the reserves are liquid and safe, you could see a run, many trying to convert USDT into dollars at once, which could force Tether to liquidate assets, potentially crashing markets. In that sense, calling it an economic heist isn't just rhetorical. The claim is that something built to be stable and safe has become a gigantic lever, with opaque controls, swelling influence, and systemic risk. Every system has a weak point. Even the strongest-looking systems have pressure points. And when it comes to Tether, these weak spots are what keep critics up at night. The biggest one is trust. If too many people holding USTD suddenly decide they want out, if they all try to cash in their tokens for dollars at once, Tether might not be able to deliver quickly, especially if a chunk of its reserves are tied up in assets that can't be sold overnight. That risk only grows when you remember how much of Tether's balance sheet is parked in US Treasuries and similar instruments. If interest rates swing or demand dries up, those assets could become harder to use in a hurry. On top of that, there's the regulator problem. Governments could easily step in with tougher audit rules, new restrictions on stablecoins, or even direct bans in certain markets. And because Tether is so deeply woven into crypto, from exchanges to lending to DeFi, any disruption wouldn't just hit one corner. It could ripple everywhere, fast. And then, of course, there's the core issue: transparency. Without a full independent audit, no one really knows what's inside the vault. People are forced to fill in the blanks with assumptions, and assumptions are often where crises begin. So assuming we take this seriously, how do we guard against a collapse, stress test our positions, or just stay informed? Well, the first step is simple but not easy. Demand transparency. Crypto was built on the idea of open and verifiable systems, and yet the biggest stablecoin still operates in the shadows. Full audits, real proof of reserves, and regular disclosures should be the baseline, not an afterthought. Regulators also play a role. Clear rules on what counts as a valid reserve, how stablecoins report their holdings, and what powers authorities have during a crisis could take a lot of the guesswork out of the picture. For anyone investing or trading, it comes down to strategy. Don't put all your trust in one coin. Spread exposure across stablecoins with stronger reporting, and always keep enough liquidity to exit if things turn fast. Keep an eye not just on the tokens themselves, but on the health of the assets backing them, especially US Treasuries, and notice when sentiment starts to shift. Because here's the reality: crypto isn't a separate island anymore. It's tied into traditional finance in ways most people don't even see. A shock in one corner can ripple through the whole system. And that's why the story of Tether isn't just a crypto story, it's a financial story that affects everyone. So as we wrap up, we're left with the question: is Tether simply the plumbing that keeps modern markets flowing? Or is it laying the groundwork for the greatest economic heist of our time? Whichever way you lean, one thing's clear: Tether isn't just another token. It sits at the center of a system that touches everything from crypto trades to US government debt. If it holds, the machine keeps running. If it cracks, the ripple effects could be enormous. And that's why staying informed matters. Because this isn't just about crypto diehards, it's about anyone who wants to understand how fragile our financial foundations might really be. One thing is clear: Tether isn't just a stablecoin in the narrow sense anymore. It's a giant financial actor with influence over sovereign debt, crypto markets, and investor confidence. The case against Tether isn't closed. Supporters will tell you it's safe, backed by real reserves, and essential for keeping markets smooth. Critics argue the opposite, that it's propped up by opacity, half measures, and assumptions that could collapse under pressure. The truth is, we don't know for sure, but we can't afford to ignore the red flags. Whether you're deep into crypto, setting policy, or just curious about how global finance works, this is a story to watch closely. Because history shows us that what looks stable today can turn fragile overnight. And if Tether ever falters, the shockwaves won't just stay in crypto, they could rattle the entire financial system. Whether you're a crypto investor, policymaker, or curious observer, keep your eyes open. What seems stable today might be hiding volatility tomorrow. So, what do you think? Is Tether a necessary evil, or is it the biggest risk in the financial system today? Let us know your thoughts in the comments section. If you found this breakdown useful, give this video a thumbs up and hit the subscribe button so you don't miss the next one. Stay sharp out there.